Hello everyone, my name is Zara Drews and I'm from batch 2019. So today I would like to make a video summary about what I learned in the half semester of my managerial accounting class. So in the first week that we learned about the financial accounting. So financial accounting represents just one sector in the field of a business accounting. It's a specialized branch of accounting that keeps track of a company financial transaction. So using standardized guidelines, the transactions are recorded, summarized, and also presented in a financial report or financial statement such as income statement or balance sheets. And then the financial statement, there is an income statement, statement of comprehensive income, and then balance sheets. And the balance sheet there is three parts. The first one is asset, liabilities, and stockholders equity and specific date. And then there is cash flow. The statement of cash flow explain the change in the company cash. There are operating activities, investing activities, and then financing activities. So now the corporate financial management. So there is the first one, capital investment. So it's a corporate finance tax, including making capital investment and deploying a company long-term capital. And then the second one is capital financing. It's a balancing act in terms of deciding on the relative amount or weights between the debt and equity. And then there's a short-term liquidity. So it's a corporate finance is also taxed with a short-term financial management, where the goal is to ensure that there is enough liquidity to carry out the continuing operations. Now in the second week, so what is the difference between financial accounting and management accounting? So according to the time period, financial accounting looks to the past to examine financial results that have already been achieved. So it is historical use, while management accounting looks in the future with the forecasting. And now, based on the system, financial accounting only cares about generating a profit and not the overall system of how the company works, while managerial accounting looks for the bottleneck operation and examine various ways to enhance profit by eliminating bottleneck issues. Now the efficiency. So about a business, profitability and efficiency are reported through the financial accounting. Managerial accounting reports on what is causing a problem and how to fix that problem. And now about behavior cost, there is a variable cost. The total amount of variable cost increases in proportion to the increase in the activity. The total amount of variable cost will also decrease in proportion to decrease in activity. And second one is fixed cost. The total amount of a fixed cost will not change when an activity increases or decreases. And then there is a mixed or semi-variable cost. It's a mix between the two of them. So now to calculate and analyze the cost behavior, we can use the first one, the scatter plot, high-low methods, and then regression analysis, and then account analysis. And now on the third week, we learn about the full costing. So all the results used for a cost object includes direct cost. So it's a cost specifically traced to the cost object. Direct matter is the physical items built into a product. For example, the direct matter for a baker, including the flour, eggs, yeast, sugar, oil, and water, or it's also known as the raw materials. And now the indirect cost is a cost associated with or caused by two or more cost objects jointly. And there is the overhead costs. Overhead costs are all of those costs on the company income statement except for those that are directly related to the manufacturing or selling the product or providing the services. So there is a type of overhead cost. The first one is rent, utilities, insurance, salaries that aren't job or product specific, office equipment, and then also office supplies. And there is also non-production costs, well, also known as period costs, include selling costs, general and administrative, and else. So what is the use of full costing? So the first one is it will help easier to track the profits and then also accounts for all production costs. And there's in the week 4, there's the standard cost. So standard cost is used to preparing the operation budget for the company. It will make it easier to make a pinpoint if the production cost that must be controlled. So and then there's a budget cost. It's what the total should be, and is the standard cost system a product costing that records standard cost either in addition to or instead of actual cost. There are the that we know the direct labor, direct materials, and factory overhead. And the last week we learn about the variances analysis. So there is the favorable and variances. So a favorable variances occurs when the cost to produce something is less than the budget cost. It means a business is making profit than originally anticipated. And there's the net income variances. So the profit variances is considered to be favorable if the actual profit is greater than the budget amount. Of profit variance is considered unfavorable if the actual profit is lower than the budget amount. And the last one, there is a favorable variances. Unfavorable variances is a accounting term that describes instances where actual costs are greater than the standard or project cost. So that's all from what I learned in the half semester of my major accounting class. So thank you so much for watching.